This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. So today on the show, I have Ralph Vince, and I think for those folks that have done their homework and done some reading about trading systems, and specifically the issue of how much to bet, the optimal amount to bet, you can't not help but have seen Ralph's works over the years. I'm just going to read a few of his book titles, and I'm sure some people are going to recognize some of these: The New Money Management, The Handbook of Portfolio Mathematics, The Leveraged Space Trading Model, Portfolio Management Formulas, The Mathematics of Money Management, Risk Opportunity Analysis. I'll make sure we get a link to those on the website and everything, and we'll go over them at the end so everybody can take a look at them. But anyways, Ralph, thanks for joining me today.
Thanks, Michael.
So let's jump in with something easy, because some of your works, I think for newbies, are going to require a little bit of digestion. They won't be able to they're going to have to do a little homework after our conversation. But let me jump into you in general as a guy who's, and correct me if I'm wrong, you're self-taught, where your background is from what I understand, not college, and you have crafted some very detailed, comprehensive looks at the optimal betting strategy, so to speak, for traders over the last 20 plus years. So start that for me, give me Ralph Vince as a 13-year-old kid.
Well, that scares me. I try not to even think about those years. But if I did have half a brain, I would have dropped out of school in first grade.
Hold on, first grade. First grade.
I don't mean that disparagingly. I just mean I had a bad experience going through school. I don't know if it's typical of men and the way men's minds work. I've heard other guys kind of say the same thing to me, but I was about 24, 25, 26 years old, and literally in the course of one day, I remember thinking to myself, I've been really stupid my whole life. We do dangerous things that we can get hurt doing. And the very same day, I was looking at the Black-Scholes model, and it made absolutely perfect sense to me. And I found that I innately understood a lot of pretty involved mathematical stuff and just poured myself into it, and it came very easily to me. But it's something that was... There was actually a watershed day where I woke up one day and that was there waiting for me. And a couple of years later, I think that first book came out, and that's my story. It's not something that.
Hold on, Ralph. That was a dodge. You went from 13 to 25 really fast. You just missed a decade. Where'd that decade go?
Why are you making me relive all those awful years?
Well, because other people are going to learn from this. You can't just skip a decade. If I allow you to skip a decade, they're going to all come down on me and go, Covell, you let him skip a decade.
I don't really remember much about
that. You just came out of an egg writing portfolio management formulas. Is that what you're saying? You just came out of an egg and just started writing portfolio management formulas. Nothing else happened. Someone's going to go pick up this book and they're going to go, you know what? Vince is not telling me the full story.
Well, you know what happened? I think I was 19 years old, and I was looking for a job.
We're getting close. We're getting closer to 13, though, at least.
Well, we're getting closer. That's as close as I'm going to get, too. I'm telling you right now. And I had a rust-colored kind of polyester sport coat, and I took the bus into town and just walked in places off the street. And the woman asked me, "Are you here for the job about a margin clerk?" And I said, "Yeah." And she says, "Well, you're the first guy we've had." And she gave me this big, thick orange book that said Federal Reserve Board Regulation T. And she said, "Be back here Monday to start." And I got on the bus, and I opened up this book, and I thought, what in the world is this about? And at that time, the particular firm I was working for went through some mergers, and they didn't have this is going way back, but the margin requirements for accounts that were okay to trade short options were not computerized, so we had to do it by hand, pairing of the legs and so forth. And that was my first job in the business, and it was a real baptism by fire. And I think I was getting paid like $179 every 2 weeks. And I bought some Amarada Hess calls, and some conflagration broke out in the Middle East, and I made $4,000 in like 2 weeks' time. And I'd never, had an experience like that, and I thought, this is really something here. This market doesn't care who I am or what I know or where I went to school or who my father is. This is as fair a playing field as anything on the planet, and I love this. And that was really how I got started in the business. Then I started, the PC came on a few years later, and I kind of took to that, and guys would hire me to program up their trading strategies, and that's really where I started having certain insights into things.
Well, let me ask you this. We've got a mutual associate going back some time, and I always give him props for, he's one of the first guys to review some of my work, Gibbons Burke. And Gibbons and I are connected on Facebook, and he actually was prompting me for a question that he thought would be kind of getting at some of your background. And he thought that, thinking back to his experiences with you, he thought that perhaps the fact that you were outside, hold on. He was very serious. He said, perhaps the fact that you were outside the system, outside the typical college educational type process, that allowed you to think about problems differently. Or helped you to think about problems differently. Speak to the notion, before we get into some of your more detailed understandings about trading. Speak to the notion of education and perhaps how you might have come about things differently.
Oh, I don't know if it was a function of education or lack of. I have to tell you, I have been kicked out of every institution I've ever attended, except the ones where they lock the door when you come in, for better or worse. And I think a lot of kids in school and in high school are like that. If you sit there long enough, you will go screaming insane. And that was always a problem. I don't know if the absence of that amended my perspective on things, or if someone who goes through the system thoroughly ends up with a very crystallized perspective. And I think that's a function, too, of what continent somebody grows up on. I mean, it seems on the North American continent, it's a lot less likely to happen. It's a lot less likely to happen to guys who grew up in Australia. In other parts of the world, they tend to be a lot more crystallized. I find Russians tend to not be nearly as crystallized when they're formally educated. And it's just an observation from a small sample set, my own personal experience. But so I really can't answer that question. I don't know if that was because I didn't have the formal education, or if the formal education would have been harmful in that regard. I honestly don't know. I only have lived one path, not both.
Well, let me let you pick up where you were. I kind of interjected that. Let me let you pick up where you were talking about as a young person, early 20s, margin clerk, and let you pick up some of your next steps in your progress. If you want to.
No, okay. Well, I started. I got a call from a guy who they were doing back office processing for Amex firms, and asked me if I wanted to come work in New York. I went to work for them, and that's really when I started having access to price database, the different exchanges and so forth, and was able to start testing things out. There weren't a lot of guys back then really doing that. And next thing I know, I'm getting calls from guys who are professional gamblers, and they're willing to fly me out to Las Vegas to test out their betting progression and so forth. And some serious traders. One of the most notable, of course, was Larry Williams, and that was really a great experience for me to be writing code for him. And you're going through, let's say, the crash of '87 as a fly on the wall there, or more. It was a great education for me, and that was where I think having access to the computer where you could do, let's say, millions of runs overnight is kind of what changes your perspective from, say, our father's generation, where they didn't have that. They were able to see anomalies in how the waves of data come across from what we would expect. And those anomalies raise questions, and the pursuit of those questions, yield some interesting fruit here. At least that is the case with me.
Well, let me ask, just to clarify the date. So your start, you're talking about what, 1980, roughly?
Yeah, 79, 80. I remember the 1980 bull market, if you can call it that, which seemed like it at the time, was really where my first real memory of trading the market back then and coming into the election at that time and so forth.
Right.
I mean, prior to that, I was aware. I was aware of the 73, 74, 75 era. I don't know how you could be walking around the planet at that time at any age and not have been aware of that. But the market of 79, 80 was my first real recollection. And then August of 82 was a real wake up to me too. And I think there's a lot of parallels to that era and probably what we're in right now, at least in terms of the math psychology and so forth.
Well, let me ask. I definitely going to make a note here because I want to come back to that too. But as you move into, and this is what you're known for, and you've done so much work in it, the kind of how much question, the optimal size question. Can you trace the beginnings of your work back to, for example, Ed Thorp's work? Was that your light bulb for you? Or is it other sources?
Not really. The determining factor was I was, well, it goes way back. This does go back to first grade. It goes back to maybe even before that when Dad came home and asked Mom, "Do you want to watch football?" And she said, "Well, I really don't like watching, football. I'm really not too excited about that." And he said, "Well, I bet you'd be real excited about it if you knew the house was writing on it." And at that time, I was, well aware of the idea of a gentleman's bet and so forth. And I remember kind of making a mental note that there's this spectrum of this wagering spectrum between a gentleman's bet and wagering the house being where when you lose that, it's over, okay? And that kind of segued back into my life in the future when I was actually looking at some accounts of, some managed accounts of Larry's and his own account, and what we were seeing coming back in terms of runs from the computer showed, let's say, a positive run over a given window of time, but the accounts themselves were down. And one of the things he wanted to know was, how can this be? That you must have a bug with the program. And of course, as a programmer, you think the problem is with my code, and went over that with a fine-tooth comb, and that wasn't the problem. So really trying to find out, okay, what is the problem? What is causing what we're seeing here? And that, at the same time, sometime earlier, a guy named Bruce Babcock, who I was doing some programming for, did give me, he was always giving me all kinds of things that he was reading. And one of the things he was reading was Thorp's Beat the Dealer. But I really didn't give the Kelly formulas as presented in that a great deal of thought. It just didn't resonate with me as something that was really applicable to what we were doing until I solved the problem with what we were seeing with those accounts in Larry's shop there. And since then, I've been unable to let it go.
Well, yeah. What do you? I'll describe this in simple terms, and I'll let you elaborate. But basically, and correct me if I'm wrong, a lot of your life's work is basically saying there is an exact number of shares or contracts to trade if you want to maximize profits, no more, no less, and that's the bottom line. And now from there, things can get more complicated, but at the pure math level, that's what the deal is.
Right. In its simplest terms, there's an amount to wager that will maximize your gain, And if you wager more than that, you actually begin losing money. That's the starting point for it, Michael, but that's not the story. And it's been a source of great frustration to me is that however much I've tried, that explanation only says there's a peak here. And let's say it's a peak to a curve or a peak to a landscape if we're trading more than one thing. And the real story is in the contours of that landscape, the peak being a point of reference to that curve or that landscape. For a long time when I was younger, I thought it doesn't make any sense to be anywhere other than the peak. But as I say, I've been unable to let go of this. And the more, even though I've consciously tried, it still is bouncing around back there. And the more that kind of shows itself to me in regard to this, the more I realize, wow, the real story is in the shape of the curve and how you traverse that curve rather than just being at one stationary point. That's the real story. And to me, the real key to everything in the markets is the path I take on that curve or through that space. And not simply where the peak is and being at the peak.
Do you have a way, because I can, as I listen, I'm following where you're going. I know for the audience, you're jumping into some fairly complicated thoughts, even though they're not expressed that way just yet. But is there a way, have you used over the years any good analogies or stories to get people to come into this understanding of talking about the peak, the landscape, the trade-offs, navigating it, traversing it? Have you anything good that's resonated with people to get them to wrap their arms around it?
Well, I think part of it is to think about it in terms of being absent math, okay? Don't think of it in mathematical terms. Think of it in graphical terms, because that's where the story is. The math is just an articulation of where the peak, what the shape of the curve was in the past, okay? And there's going to be a curve in the future here. And in fact, it'll be as much like the past, depending what size data width you use and so forth. And we can make good estimations about that. But if you think about it in terms of, okay, forget there's any math behind this, but accept the fact that there's a peak. So if we make one trade, okay, or risk something for one event, there is no peak. There's a straight line, say, if it's a positive expectation. That straight line being that the amount we risk, say, along the horizontal axis between the gentleman's bet and wagering the house, okay, and what we expect to make. And if it's a bet that has a generally positive expectation, it has an upward slope to it, such that, well, you expect to make the most on average if you wager the house. And if you wager nothing, you expect to make nothing. When we get into more than one play, okay, where what we have to play with on subsequent plays, or the amount we have to use on subsequent trades, is a function of what we made or lost on previous trades or plays, that straight line becomes a curved line, and that curve then implies that there's a peak. And that peak then is where you would expect to maximize what you would expect to make. If you envision that, you understand the whole of it. And I would just say that, okay, so the big question is, where is the peak? Okay, number one. And number two, the biggest overarching question, and something that no one ever, in terms of individuals, addresses, what's your criteria? What are you doing here? Why are you doing this? And being able to come to a very well-articulated criteria for why we're in the markets seems to be the biggest impediment to most people. And I would say that in 30-plus years of observing market participants, it seems to be the biggest determinant between success and failure, is those with the ability to articulate what they're doing here. I mean, how many pension funds really go bust as a percentage of the total pension funds out there? It's really very little. I mean, they're struggling, yes, given the circumstances, but they have a very well-articulated criteria. We have a 5% liability, say, for 2014. That's our criteria, is to meet that liability plus. But the individual has much sloppier criteria, and I think that's a real problem. Because once you can articulate what the criteria is, what you're trying to accomplish, now you can look at that curve and say, okay, now I know what to do here on that curve. Okay? An easy example would be, I'm an individual. I'm here to make as much money as possible in the marketplace. I want to just maximize my gain. Okay, then what you would do with that curve is you would want to be at the peak. Okay? Stop me if I'm rambling, Michael.
No. I don't want to get too far into the abstract. I'm jotting questions down as you go. Keep going. Don't stop.
Okay. Well, I think that, and to me, this is where the trading exercise begins, not with the price charts and so forth. Okay. So let's say a guy says, okay, my criteria is to maximize my expected gain. All else be damned. I'm willing to sit through a 99% drawdown as long as I know I'm maximizing my expected gain over, say, the next 2-3 years. And he wants to be at the peak. So the next question becomes, okay, where is the peak? And, well, briefly, and I'm not disparaging Kelly in any way at all, but the problem is that the peak in the Kelly world is not bound between, let's say, a value of 0 and 1, okay? And I would recommend using my formulas for doing this specifically because they're bound between 0 and 1. And by doing that, we can convert that number readily into how many shares or contracts or so forth, but it gives us a frame of reference, particularly when we're talking about more than one market or system being traded simultaneously. In other words, it lends itself towards a better portfolio construction. That said, let's talk about estimating where that peak is going to be in the future. And let's talk about a guy who's doing a trend-following program. Let's say we're trading commodities, and we're a large Middle Eastern sovereign wealth fund, and we will only accept commodity advisors who have mechanical trading systems that are trend-following. And so we invite them out one by one, and we find that, yeah, there's a good correlation between them depending on what markets they trade and so forth, but basically, most of these programs are right, say 30-35% of the trades are winning trades. Now, when we're bounding our value between 0 and 1, we find that if we minimize the amount that's lost on losing trades, and we minimize it and make it ever smaller as, let's say, the one of winning trades approaches 0, we find that the peak occurs right at the percentage of winning trades. So the peak in that 0 to 1 landscape would be between 30 and 35. And if we expand the losing trades out to where these systems become losing systems, well, then the peak is at 0. So we know that if we can determine what the percentage of winning trades is going to be over an adequately long enough window of time in the future, we can say the peak of this curve will be between 0 and P, P being the probability of winning trades in the future. So for our trend following, guys, we're looking at a value between 0 and 0.3, 0.35, the percentage of winning trades. Now, we know that's the window that it's going to come in at. The question is, where in that window is our best guess? And the best guess happens to be half that value. For mathematical reasons, I don't want to really get into without boring the listeners here, but you can make a very good guesstimate of where the peak is for a given trading system as that value of the probability of winning trades divided by 2. So for our trend following guys, if they're between, let's say, 0.15 and 0.18, that's about where their peak is going to be for an adequately long enough window of time in the future. Okay, so now we have a peak. We're able to begin sketching out a future expected landscape or a future expected curve for this system. And the only math we've done, Michael, is we've taken the probability of winning trades and divided it by 2. Okay, so with I get back to my overarching point here, that is to think about this stuff graphically and not be deterred by the math. I've been accused of being a mathematician by a lot of people, and I'm not. I'm anything but. I mean, I look at it as a tool like the computer and so forth, but I don't possess any great mathematical aptitude, that's for sure.
I mean, when I look at your work, and when I hear you talk, I look at you as a guy that's like, hey, there's a problem here to be solved. A lot of people are avoiding the hard work of figuring this out, and your passion is like, hey, where's that optimal spot? It doesn't necessarily mean that you have to exist there, but you need to know where it is to make your decisions and understand the trade-offs.
The optimal spot, however, Michael, is a function of one's criterion, okay? The optimal spot would be the peak if the guy's criterion is maximize expected gains, all else be damned. One of the things I'm working on here that's really of great interest to me is there's an inflection point on this curve that develops, okay? That is, if we start from 0 and we start traveling towards the peak, okay, let's go back to a trend following system where the peak we expect to be at, say, 0.15 for a system that we expect to have 30% winning trades in the future, our trend following system. Then as we let's say we're traveling from 0 towards 0.15, that curve is concave up initially, and before we get to the peak, it goes to concave down. It's rather bell-shaped, okay? So, in other words, initially, we're gaining gain at a faster rate than we're assuming risk, and then that flips over. Well, that point where it flips over is a very significant point, that inflection point, because it says that's the point where a marginal increase in gain is beginning to decrease for a marginal increase in risk. And I would posit that point is very critical to a lot of money managers and maybe for a lot of individual traders, and possibly even more critical than the peak itself. And I'm working with a couple of real heavy-duty math guys here from, one in particular from the University of Western Michigan. And we're going to have a paper out on that here within the next year. And I think that's for certain criteria, that's a very important point. So someone's criteria may be that, hey, I manage customer money, I cannot afford more than a 10% drawdown, so I cannot risk more than, say, 1% per trade. A simple solution to satisfy that criteria, you can see where they exist on the landscape. And to take it one step further, you don't have to be at just a particular point on the landscape, but people are kind of inadvertently traveling around it if they're arbitrarily changing their position size from one trade to the next. And I find that not just the point you're on, but the path you traverse this curve or the landscape, if there's more than one market you're trading simultaneously, is critical to satisfying a given criteria.
Hey, Ralph, let me interject. So you just mentioned the guy who's maybe he's got the client and he says, oh, I can only stomach a 10% drawdown, and so you figure out, okay, the amount of risk one has to take to make sure they can kind of try and stay in those confines. Except, however, the psychological part of it, I would imagine, is that for those clients that say, I can't take a lot of risk, I only want this amount of drawdown, they don't seem to understand they're limiting their upside. And then when the upside happens for everybody else, they get upset that they didn't get the upside too.
That's a common thing we hear. People are always moaning and groaning about it. Who was the guy from Fidelity who was fired in the late 90s who went into bonds there and still showed a good return, but it wasn't keeping pace with the 97 market buyback?
I tell you what, let me phrase it this way, because I know this is a passage where you talked about one of your examples. So let's say the portfolio manager's job, it's, as you say, it should be easy, maximize profits. And I've seen you use an example where to maximize profits could result in a 95% drawdown, and clients should be happy about that. And now I'm sure some people are probably sitting out there going, Coveil, Vince, why should I be happy with a 95% drawdown? And Mr. Vince is now going to explain why you should be happy with that.
Well, this gets back to the path that someone, say, traverses through this space or along this curve. Let's go back to our curve of a trend following system where we say, okay, the peak we expect is at 0.15. Somewhere between 0 and 0.15, this curve is going to go from concave up to concave down. And by the way, at some point beyond that 0.15, that curve comes down to the point where you ensure that the person will lose money on this, okay, no matter how good the system performs. I'm just throwing that out there, but I don't want to get sidetracked. Now, we cover a path on this, and let's say our path is we're going to practice portfolio insurance to try to satisfy a customer with exactly that appetite that you discuss here, okay? So we're going to be somewhere along this curve by mimicking the delta on a hypothetical call option. And as the track progresses to the upside, we're going to be increasing his position size, okay? That, at some point we may have him 100% invested in this. So we're actually moving along this curve on a value between 0 and 1, which would be the value that mimics the delta on that particular trade. So that, if this thing starts losing money, we're pairing off on the position size. If it begins making money, we're adding to the position. We're now covering a path along this curve. Part of the problem with doing that, incidentally, is portfolio insurance, to satisfy the criteria of this investor you're speaking of here, who really wants to participate on the upside and expects you to minimize his downside risk, is one of the artifacts of that is, in so doing, you will also lessen his time at new high equity. In fact, if you do the opposite of that, you'll increase his time at new high equity. So if you want to increase your customer's time at new high equity, he's got to learn to accept underperforming the market during some substantial run-ups, in other words.
Right.
There is no free lunch.
Well, it's the psych. Well, it's funny you mentioned that too, because obviously, and I'm kind of taking a sidetrack here, is that if you look at 2008, a lot of folks will say, and obviously this covers a lot of different types of systems and approaches that people were using, but they'll say, well, diversification is the only free lunch that you get, and then a lot of different strategies in 2008 that were so-called diversified woke up and realized, that didn't help me. Everything dropped in tandem. And I think in your world, in your arguments, you might say to people, hey, instead of focusing as much on diversification, maybe you should be focusing on the size of how you're trading. Why don't you speak to that for a second?
Well, that's interesting you bring that up, because first of all, and this is part of why I've been unable to let this stuff go for decades, the conventional notion of diversification as one of ameliorating risk is a absolute fallacy. There really is no free lunch. You get something, you give something up. And this is an illusion wrought by the mean variance approach to portfolio construction. Let me back up here. Okay, we know we're at some value between 0 and 1 for each market or system we're trading. And there's a curve there. Now, if I begin trading 2 markets or systems in my portfolio, now I have a curve in 3D space. If I trade 3 markets or systems, I have a curve in 4D space, and on and on. And I mentioned that at some point beyond the peak of the curve, between the peak and 1, okay, the curve comes down to a point where you insure losing money on the position. Let's assume we're tossing a coin, and it pays 2 to 1. Okay, we're playing 2 of these games simultaneously. if I look at playing one of these games simultaneously, if I bet beyond 0.5, okay, my expected gain as a multiple on my stake becomes less than 1. Now, if I'm multiplying my stake by a number less than 1 over and over again, I'm approaching 0. I'm going broke. At 0.5, that represents betting $1 for every $2 I have in my stake, okay? Even in a very favorable game like this. And I ensure my demise doing so. Now consider, if I'm betting $1 for every $2 in my stake, I'm not borrowing anything. I'm not on margin, okay? This is straight up in a cash account on a very favorable system. Now, let's extend that out to doing 2 of these games simultaneously. Now I have a curve in 3D space, okay? If I'm off, and imagine I have an axis going east-west as one of these games and north-south as the other one of these games, and the altitude is what I expect to make or lose. And I have a peak in this altitude. If I'm off on one axis, the net altitude is less than 1. In other words, if I'm off on one component, and how I'm progressing my trading on one component in a portfolio, by a certain amount, and this does not include borrowing, okay, I ensure my demise. And this completely contradicts what we find with mean variance. But I can go back and prove mathematically this is what's happening when we trade, and which is why I say mean variance is a fallacy. It's a proxy for building a portfolio in a normally distributed world. But
hold on, Ralph, I thought the world was normally distributed. Come on now.
Well, but I mean,
it's not. You mean the markets don't work that like that? There's outliers, there's extremes, there's edges. Come on.
Well, I mean, it doesn't work the way we see things working in a mean variance world, and diversification allows us a higher altitude, but it doesn't ameliorate risk for us in any way. Ameliorating risk is a function of risking less. We can do that more efficiently, and mean variance does that, but I wouldn't call that efficiency a free lunch.
But I mean, as you say that, you know that the vast majority of folks out there managing assets for other people, they're not operating under what you just said in the last minute.
No, they're not. And I think they do so at their own peril. And there's all kinds of problems associated with that approach towards portfolio construction, one of which is simply looking at the correlation of various assets. I mean, that's great if you want to find out. Correlation's a great tool to say, here's an indicator, here's a market, here's the correlation between the two. It's a great indicator that way. It's a miserable indicator in terms of using it to combine assets together in a portfolio. And again, that's what 99% of the world is doing to their peril. And over again, we see these so-called black swan days that are, it's a real misnomer. They're a lot, of course, they happen a lot more frequently than.
Ralph, what percentage of folks out there? Let's just put aside the wiser hedge funds that understand, for example, where you go in your work. Let's say the wiser retail traders, independent guys that understand your work and are aware. But let's just talk about the vast pension fund armies out there that are managing folks' assets. What percentage of them are even remotely thinking about maximizing profits or thinking about your work and the idea of risking an optimal size? What percentage of them, is this even crossing their desk? You've probably got more experience than I in seeing these folks out in the light of day, but
if it's 0.1%, I'd be surprised if it's that high.
Yeah.
If it's 1/100%, I'd be surprised. And in fact, especially in the pension world, and we're seeing the returns coming out of these big institutions now, where the variance in their outcomes has gotten much greater in the last year as this zero interest rate world continues on. Their desperation to meet their liabilities getting ever greater.
Ralph, how do you see that? How do you see that manifested? So, as we're in this ZIRP world, this zero interest rate world, how do you see that desperation manifested?
I personally see it manifesting by some pension fund managers trying to getting real fast and loose with things in a dangerous way. I don't want to go too far down that path, Michael.
Can you not name names? Can you not?
No, I don't. I certainly don't want to name names.
No, but I mean, can you paint the picture for people without kind of violating any privacy that you have with folks?
I mean, they all have to go through committees and get approvals by, let's say, secretaries of state, so forth, treasurer of the state, rather. But they're operating within what they're allowed to do in a way that I find very fast and loose. For instance, putting on a big index and taking it off on an ad hoc basis. So far, maybe it's been okay for these guys. But, everyone's looking for where they can find that 300 missing basis points they desperately need each year. And I just find they're taking ever greater, really desperate risks to do it. And I don't see it with a happy ending for anyone, or for any of these guys. I think there's a real need for certain products to address that. And I think a lot of what gets out there, it's such a slow sales pipeline for some of these products to get through there that I don't know if it's ever going if they're ever going to get access to it.
Products aside, though, what psychologically is going on from your perspective? Why are we at a place where massively large pension funds are making ad hoc decisions, not frankly being rational, maybe not even being logical? Psychologically, what is going on amongst just at a base level with people where we're at the point that this is happening?
That's an interesting question. I don't know, Michael. I really don't know. I think, one of the most interesting things to me is to look at how things change over the course of 10, 15 years. If you go back to 1997, people weren't able to make money fast enough. And now people are just desperate to make any kind of money. And there's a different psychology in play now than there was. But I don't know beyond that. I think too.
Okay, but hold on. How about this? Pretend you're not talking to me. Pretend nobody else is going to listen to this. So when you're having the internal conversation with yourself, what are you really telling yourself?
I look at a lot of the young guys. I look at guys in their 20s, and I look at what their expectations are, and I look at how they walk the talk. Okay, yeah, a guy might be optimistic about the future, but is he out there borrowing a lot of money to take advantage of that? I don't see anyone doing that. Okay, I think things are on the verge of a gigantic boom in these markets. I don't see interest rates taking off. I could see, inflating the money supply and all that, and interest rates just sitting here, maybe for the rest of my life. Only because there's too many people, there's too much money depending on interest rates as a free return, or a very small risk return, and I don't see that getting satisfied.
Japan 2.0?
Pardon?
Japan 2.0?
Maybe even more protracted. Maybe more protracted because of all the pension funds and so forth. I think that, and of course I could be wrong, but I just don't see all these institutions and people having the market satisfy them all. And similarly, I don't see the Thunderdome scenario of the future where everything kind of collapses into the second dark ages.
Oh, come on, man. I'm hoping for Mad Max. I want to go all Mad Max. I want to get a souped up car and a 50 caliber bolted to the roof.
Pennsylvania accent with you. Am I wrong here?
What's that?
I detect a little Western Pennsylvania accent in you. Am I right, Michael?
My father is from the Scranton area. My mother's from Southern Virginia, and what that gives me after traveling the world, I have no earthly idea.
but back on, I see a lot of people expecting things to fall apart here, and looking around, there's a ton of opportunity, and I think we've been in a sideways economic period here for about 12 years now, and it's time for things to get moving again, and I think they may get moving in a real big way here, just because I don't see the young people positioned to take advantage of that, and that really plays out with, certainly a large bull market and equities and real estate and all kinds of stuff like that.
Let me shift on you real quick and see if you'll go there with me. I know you mentioned some early collaborations with Larry Williams, but I also know, and I'm sure there's a lot of names you can't name because I know you've probably been in discussions with just about anybody that's got a pulse that knows what's going on in the trading space, in the hedge fund space. But are there any traders that you want to either name by name or not name by name and talk about either lessons or experiences in working with them over the last 20 years? Or do we have to sign an NDA and maybe you'll drip out something to us, or are you just going to be the mysterious Ralph Vince that tells us you can't tell us?
I don't want. I shouldn't want to name names, and if I do, I get guys. I get faxes from their attorneys before I wake up in the morning. And tomorrow being a Friday is their favorite day to bare their knives. But I really. There's a few I've learned a little bit from, but honestly, with me, my best trading really started in 2008 into the bear market, and I was only trading long equities. And the lessons learned from that have served me better than anything I've seen witnessing what anybody else is doing. And it's quite counter to anything anybody is doing. And I think if I had to, if I was talking to a guy who was just coming into this fresh, the thing I would tell him to do is just sit back, watch what everybody's doing, and watch all the ways everybody's going to figure out on how to screw up. And do that for a few years, and a few is 10 at a minimum, and then go do this. That seems to be a hard lesson.
Are you saying to people to literally go experience doing the wrong thing to come out on the other side?
No, I'm saying try to avoid that.
Okay.
If you can watch everybody else do it and learn from that, that's a lot better than going and learning it the hard way. And there's just so many. There's a number of ways to succeed in this. Okay, and clearly, Michael, you'll get no pushback from me whatsoever. I couldn't agree with you more. In one of the pathways to succeeding, and this is being a long-term trend follower. It takes a certain hardened gut and resolve to do it, because there's a lot of tough times where you got to stick with it and believe in what you're doing. It's probably a very tough but certain way to do it. But as there are numerous ways to succeed at this, there's an infinite number of ways to fail at it. And I think that's...
Well, we've gone over some of those today. I know I don't get a chance to keep you all morning. I know we only got about 10 minutes or so left. But one of the things I wanted to bring up, and I mentioned Gibbons Burke early on, and he had one other thing that he brought up with me that I did not know about you, and maybe you can speak to this. And he had a memory of you having a data gathering ritual using Barron's in taking prices out by hand and
it's funny you should mention that. It actually is it was a spreadsheet. I think it was originally maybe a Lotus 123 or a Microsoft multi-plan, which was the precursor to Excel, I think, spreadsheet that was originally put together for Barron's Market Lab by two guys by the name of Norm North and Greg Morris. And I happened to cross this in the early 1980s, and I thought, well, this is a hell of a database. And it had a few years to it then. I'm going to start maintaining this. And I've done it by hand every week for 30 years, no matter where in the world I was. I managed to get a hold of Barron's and hand key it in. And in fact, I even have it up on my website if anybody wants to go get it. It's at ralphbates.com.
Explain exactly what you're doing, and so people follow along.
It's a spreadsheet of weekly data from Barron's Market Lab. And I use that data in a number of different systems and models that I've put together that I track over the years. One of the interesting things about it, however, is when you key in data by hand, I think, before the computer, when you keep charts by hand, you'd get a certain feel for a given market that's different than just looking on the computer. When you key in this kind of data by hand, when you key in weekly new jobless claims every week by hand, over the course of years, you begin to get a certain feel for different indicators and what they're telling you and so forth. And it's amazing how that sharpens your gut to and your instincts about, let's say, market prognostications. That's not to say I'm not wrong. Of course I'm wrong. I'm wrong plenty of times, as much as anybody out there. But I find it's really paid off for me in what it's sharpened in terms of my sensitivities to the numbers in the markets and so forth. I've tried to pass the ball on to the third generation, but nobody wants to take it and do the work.
It's funny. There's a trader out of London who's done quite well, David Harding at Winton Capital, and he has talked about these early experiences with charts and data and just the very manual process and the lessons gleaned from it. But to switch gears here, I have one last question for you. So, as a guy who has put together some fairly interesting but complicated to grasp, if unfamiliar, books, and a self-taught guy, so I am the 25-year-old guy out there or 18-year-old guy out there. Talk to me, Ralph, about your view about education, formal education, university education. And we talked about this early on, but I just want you to kind of define maybe a map for people to think about, an alternative way to learn, and maybe to let people feel comfortable that they don't have to do it in a formalized degree on the wall staring back at you routine. Is that a good? Is that question clear? I hope it's a clear enough question.
Well, I mean, there's certainly a lot of resources to learn stuff out there. And there's more now, of course, than there was 20, 25 years ago or a generation ago. I don't know if that's the way to go for everyone. For me, it was a better way to go, I think. But again, I've only lived one path. I haven't lived the alternate path with it, so I'm speaking hypothetically. But for me, it was certainly it seemed to have opened up some doors that I don't think would have opened up for me otherwise. I don't think that's the case for everyone out there. I think different people have different needs and their abilities to learn things and what they like and so forth. And as far as the markets go, I don't know any better way to learn than to just, read everything you get your hands on, study, and, paper trade as much as you can, because it's a long learning curve. There's a lot of beatings to be sidestepped out there.
Jimmy, there's not a university course. There's not a university course that says here's how to be a trader. That doesn't really exist.
I don't think there's anything even close. And in fact, I was looking at myself going and taking some, going and getting some the quant type degree, because we didn't have that when I was younger. And the math too, it interests me and so forth. But I got to tell you, I think that everything I look at in that regard, where it's interesting, okay, I don't find any of it applicable to the markets at all. And I'm really not interested in mispriced derivatives or anything along those lines. I have to say, Michael, I couldn't be more satisfied with my own trading in recent years. And I look at that and I say, well, I don't know where you would go formally to learn that.
Well, I'm gonna.
I think they'd be very wise to pay attention to the stuff you're advocating. Again, I'll go back and I'll reiterate: if someone has the stomach to do the trend following types of things on a number of disparate markets, and they're willing to stick with it long enough, they can probably expect to do very, very well in the long pull.
Well, listen, Ralph, I appreciate it today. Let me let people know where they can find out about you. I have to say, Ralph and I were connected on Facebook and then got disconnected. I don't even think you're there anymore. I think you went off the Facebook grid, it looks like.
I had to drop out of all social media. I have nannies who required me to drop off out of all social media. So,
gotcha. Well,
it wasn't my choice.
So the reason I'm saying this is, so I went to find Ralph. It's easy to find him at ralphvents.com. And so I went there, and that was how I sent you an email from your website. So, and you responded quickly. So that is, I definitely know it works to reach you. But all of Ralph's books are on Amazon. And we're looking at the last 20 years of books. I will say this, for those folks out there that sometimes think, if the book wasn't written in 2012, it's not relevant. And there are plenty of people out there that have that wonderful logic. You might want to pick up Ralph's first book from, I think it was 92, and tell me the parts of it that I mean, I'm sure Ralph, I know you keep advancing things, but the foundations that you established are timeless. I mean, there's a lot of timeless work there. So, ralphvents.com. And Ralph, I appreciate it. I hope we can talk again soon.
I hope so, Michael. Thank you very much.
Thanks, man. Take care.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash, or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.